Hello again, everyone. This is Ned Desmond. I work for SOSV. SOSV is a multi-stage venture firm that operates the IndieBio and Hacks startup development programs in hard tech and life sciences and climate and in health. So we're here today for a very interesting session with corporate venture capitalists who are going to talk to us about how they see the world. And our moderator for the conversation is SOSV's Pae Wu, who is the Chief Technology Officer at IndieBio in San Francisco and a general partner in SOSV's fund. Today, just one little administrative point. If you have questions, and we love questions from the audience, please put them in the Q&A function on Zoom, where we can keep an eye on them and hopefully get them answered. So with that, I'm going to hand it over to Pae, and I hope everyone enjoys the conversation. Thanks, Pae.
Thanks, Ned. Hi, everybody. Thanks for joining us. We have a really exciting group of investors here today, and I just wanted to set the stage a little bit and I think take some time to recognize that there has been quite a bit of change. You know, pre-pandemic, the startup community, I think, thought they knew how to work with CVCs. Oftentimes, CVCs were entities who typically wanted to wait for commercialization, not come in too early. And ultimately, the goal was to maybe steer a product to the right landing zone inside the mothership. So the common refrain was, you're too early, come back when you're commercial. And this actually worked out really well for everyone involved, startups, their investors. Everybody wasn't too interested in getting overly entangled too early with strategics. But certainly times have changed. And as climate investing and climate targets become so mainstream, even the US government is getting in on the act. Climate tech startups, their investors and corporates, many of whom make up the very legacy industries we need to decarbonize, are embracing each other earlier and earlier. I think the last couple of years, we've seen increasingly strategic behavior from CVCs, much more forward-thinking investments that can augment or even open up blue lines of business in legacy industries, working on decarbonizing entire supply chains, and even a general, I'd say, vibe that corporates are working more and more closely with climate tech startups to plot a new course, to be more proactive, and to partner early and often. And this even looks like early checks, pre-commercial investments from the CVCs. And what it looks like from where I'm sitting is that CVCs are taking a much more active role in deciding the future of a corporate and even entire industries, rather than saying, well, what is that disruption that's coming? This is no more prevalent than what we're seeing today across climate tech, and why we're here today with three highly active, very strategic CVCs with very impressive climate bona fides. One is a global leader in mobility and motors, Honda. And today we have Honda Innovation's very own Adity Sharma. Welcome, Adity.
Yeah, excited to be here.
Thank you. Another is the early stage venture arm of GS Group, one of Korea's largest conglomerates that has deep roots in petroleum refining. Welcome, Taehong Huh.
Excited to be here. Thank you so much for having me.
Thanks for being here. And finally, a climate innovation fund created by the original big tech company, Microsoft. Welcome, Brandon Middaugh.
Looking forward to the conversation.
Well, thank you all for being here. And I thought maybe just to help the audience get caught up to what y'all are doing, I'd have each of you give a brief introduction about how your organizations are addressing your own climate goals. And so why don't we start with Adity from Honda?
Sure. Thanks so much, Pae. So for Honda, we're looking at disruptive technologies and business models to help address Honda's 2050 net zero goal. There's three pillars underneath that that we're specifically focused on, one being carbon neutrality, the other being clean energy, and then the third being resource circulation. So we're looking at a number of different startups in the ecosystem that fall within those three verticals. And even looking beyond those verticals as we think about the longer arc Honda, and looking at what's to come in the future that maybe, there's small signs of in the startup world. There's innovations happening that don't directly address what's happening in 2050, but really think beyond that, like technologies like fusion and quantum that are really whose foundations are being set now, but are going to be game changing 2050 and beyond. So that's really how we look at climate tech investing, and the broad categories that we're focused on as we, in the near, mid, and long term, as we think about our investment targets.
Great, thanks. And Tae, maybe you can share a little bit about GS and GS Futures.
Absolutely. Thank you, Pae. So GS Futures, like Pae introduced us, is the early stage US/Europe facing corporate venture arm of GS Group. But before I introduce GS Futures, maybe a couple words on GS Group. So GS Group was started in the 1940s as LG Group, and LG, started by two families, grew successfully into many, many different industries, both horizontally as well as vertically. And in 2004, LG split into two, LG and GS. I'm sure a lot of the folks in this call today is more familiar with LG. But GS, I would categorize this as being in three key traditional industries, with our largest assets being the energy space. So in the energy space, we are the #1 independent power provider in Korea right now, both with fossil fuel-based power generation, but also renewable generation. But our single largest asset is a joint venture between Chevron and GS called GS Caltex, which is operating one of the largest oil refineries. Also, GS Group is in the district heating as well as natural gas space. So the second industry we're in is engineering and construction, where we're doing a lot of work on the high-rise residentials, as well as new types of kind of built environment infrastructure, including data centers, hopefully places like biomanufacturing capacity, but also carbon capture projects as well. The third industry we're in is retail and trading, where we're operating around 15,000 convenience stores, e-commerce, TV, home shopping, and hotels. And as politically challenging as it sounds, GS Futures is basically 10 LPs spanning those three industries. We're a little bit unique from other CVCs, which have a lot of different business lines, in that we're coming in together as one group, because by only doing that can we offer a more differentiated value add to the ecosystem. Because when we look at a company, and I'm sure we'll talk about collaborations, we don't only look at it from a singular angle. We look at it from an energy angle, wastewater treatment angle, also consumer angle, as well as we can help you build capacity if you need by bringing our project financing and EPC angles. So our investment mandate is pretty wide. We are an early stage investor. We want to take risks that our business units can, or our balance sheet investors can't. So we want to invest early on, be a little bit more venture than corporate initially, but only help the companies out when they are ready to engage with our business units. So we look at climate tech. Within climate tech, I think some of our focuses are carbon utilization, circular economy, as well as industrial biotech. Energy transition tech is also where we spend a lot of time. That's everything from next generation energy storage, next generation power generation, as well as how do we understand supply of electrons, demand of electrons, and finally solve this inefficiency in that marketplace, both from a hardware as well as a software standpoint. The third industry we invest in is built environment, digitalization of one of the largest yet least digitalized industries, but also how can we bring sustainability into the design as well as the materials of one of the largest industries. And then the fourth is consumer tech, where we have a little bit more freedom to be creative and fun. Gen AI, pure retail tech, but also metaverse. Those are all areas that we look at. But yes, sustainability is probably the biggest focus we have across those four themes. And I'm happy to share any insights I can today.
Great, thanks. Brandon, the Climate Innovation Fund has been front and center in climate tech for some time here. So I'd love to hear a bit more about how Microsoft is doing this.
Great. Microsoft launched our Climate Innovation Fund in 2020 as part of our sustainability commitments for the decade. So Microsoft has a goal to be carbon negative, water positive, and zero waste by 2030. And we recognize that the operational measures we take within the business are really dependent on a broader market and innovation ecosystem outside of the four walls of Microsoft. And so the Climate Innovation Fund is a $1 billion balance sheet initiative. It's one of 3 impact funds that Microsoft manages, and it operates independent of our main corporate venture arm, which is M12. So we are investing on behalf of the parent company in climate solutions around the world. And the real focus areas that we are prioritizing are carbon, water, waste, and ecosystems. From a technology perspective, we invest across energy systems, industrial systems, and natural ecosystems. And the thesis is largely around investments that will accelerate our path to net zero and that of our customers, investments that demonstrate the applicability of AI for sustainable solutions, and investments that build and develop the markets of the future. We have 4 non-financial investment principles that we're looking for in terms of how we evaluate potential investments. We're looking for climate impact on a 2030 time horizon. We're looking to make an impact in underfunded markets with some social co-benefits and with alignment to our core business and that of our customers. And so with that framework in mind, we've developed an investment roadmap that is primarily focused on venture and growth equity, but has a secondary focus on a select number of infrastructure project finance transactions as well. And the team is really integrated into Microsoft Corporation. It sits across sustainability and finance. And we're 4 years into the operation of the Climate Innovation Fund and have a lot of lessons learned along the way. And, really see a very unique role for corporate players in this space to be driving and accelerating the solutions that each of these net zero corporates needs to buy in order to achieve their goals.
It's super interesting to hear. And actually, I'd love to open this up to all the panelists about the non-financial priorities that do get integrated into your decision process. So I'd love to hear, how are you all looking at, especially in the early stage? We'll try and kind of focus in on early stage investments that maybe are less traditional for other types of CVCs. Are y'all taking kind of a tech first approach? Are you taking a business unit first approach? Is there sort of an internal strategy around new opportunities that you all are explicitly looking for? I'd love to hear a little bit about how those, in addition to the financial priority, how are y'all integrating these other non-financial, more strategic priorities into your thought process?
I'm happy to jump in.
Yeah, sure.
With some thoughts on that. So, yes, I would say we are taking a technology first look at that. So we've done some analysis to understand the relative capital flows across the different, sectors within climate tech. And we've identified a few that we see as particularly supply constrained over the next decade. And so a lot of the strategy is really solving those wedges of the sort of decarbonization trajectory for the global economy. A few examples: firm carbon-free electricity, advanced materials, sustainable fuels, and carbon removal. Those are 4 that we see as highly supply constrained areas within the broader trajectory to net zero, and also relatively underfunded by comparison to what we understand is needed. Those would be a couple examples, and then water and circularity would be just right behind those as well. And I think that tech first decision tree, followed by a deep understanding of the business model and scalability of the solution, that's sort of the sequencing of how we look at those opportunities.
Yeah, and I can add a little color from our end. I think the answer for us is it depends, in the sense that there's some technologies that we look at that are tech first, because we either, we have some roadmap or we have interest internally, but it's very new, like quantum, right? There's a lot that still needs to be figured out. And so quantum, we're taking a tech first approach, but there's other areas that are, we have a very robust BU around, we have a roadmap like battery recycling that's BU led. And so there is technology consideration, but again, it's dependent on, there has to be a big push from the BU, and maybe even BU led to say, yeah, this is an area this is a company we want to double down in, or, however they see the collaboration, and that's how we support that infrastructure or that engagement. So for us, I think it's dependent on the technology, the timeline of that technology, right, where they are in the development, and then do we have a roadmap tied to it?
Interesting. And Tae, I know you all are quite strategic. Oh, you're on mute.
So we are strategic, but to a certain extent. So the way that we like to think about it is we do have obviously a lot of BUs. We have 10 different BUs spanning different industries that we work very closely with. So what we try to do is we try to understand what their new business initiatives are. So what are they planning to do in the next 3 to 5 years? And then what we would do at Futures is we would extract the themes. So it's like a blank piece of paper and we put a title on the paper. But that would kind of be our strategic mandate. But what we write on that paper is our own thesis, GS Futures' own thesis. Because one of the key reasons for why we call ourselves GS Futures with an S, as well as why we were created, was one of the key goals was let's create optionalities for our business units. When they have a roadmap, they are probably singly focused on a single technology, to execute. What we want to do is want to help them avoid some of those blind spots. So if they are on the topic of battery recycling, if they are using hydrometallurgy that they're licensing from a partner, we're saying, but there are other alternatives. There are other alternatives. We can start looking at other technology providers. Also, we're seeing, some of our friends in the industry approaching different ways. So we work very closely with our business units. We don't need business unit approvals. Sometimes we actually disagree with our business units. Sometimes they happily say, Tay, I told you so. But in many cases, we also say, we told you so to the business units as well. So it's always a good question, strategic versus financial. I would say at a high level, we are strategic, but where we invest, how we invest, we should always think like a financial investor. Because just because a company that's not doing well financially, or a company that we only chose because it's strategic to us, it usually does not pan out as well. So we're okay being on the tail of a dragon rather than being on the head of a smaller creature.
Okay, one reminder to the audience, please do drop your questions into the Q&A section on the bottom of your Zoom screen. I think it's really interesting to think about the, let's say, internal politics of having to sort of navigate and shepherding some of these early stage startups and being able to leverage the strategic opportunities within your corporates and how you have to manage your relationships with the business units as well. I don't know if you all have any anecdotes or stories to share around how an early stage startup and you all can work together to bring that engagement into the mothership in some way, shape, or form, and how you all are able to help those companies and those founders understand the the internal context of what might be happening at your companies.
I can kick it off very quickly. So I would say number one, understand. So a couple, I would say, tactical advice for the founders. First is always bucket your customers into different priorities. A lot of the corporates, business units, if it doesn't work in the first meeting, or I mean, we're very impatient, and especially depending on which business you're talking to, fail fast. Those mentalities don't really work. So if they didn't appreciate the first meeting or the second meeting, there is a big chance that that corporate might not re-engage with that startup for at least 2 to 3 years. So what I would do is bucket them into 3 priorities. I'd always have a North Star. This is my perfect customer, corporate customer. Leave that to meeting 15 to 20. Speak with 10, 15 companies, lower hanging fruits, where you can make mistakes. But every time you talk to a corporate, you're gonna be more corporate ready, because there are some nuances that you need to understand, including understand who you're talking to and cater your pitch depending on that. If you're talking to the R&D folks, cater your conversation around technology. When you're talking to the strategy folks, don't talk about technology, only talk about ROI. Like what this is going to do to you, why this is not disruptive to your current status quo, and that this will help you make money. Focus on the benefits, not the features. But when you're talking to the R&D center, obviously cater your pitch. And also you just make sure the corporates they always appreciate if you've done a little bit more homework. So a pitch to, for example, LG should be different to a pitch to GS. Just understanding that nuance. It's a little bit like 30-minute research, but those go a very, very long way. So, and also, yeah, you just need to have some internal champions. So always take advantage of folks like Adity, Brandon, and myself that understand the corporate politics, but that is trying to help you, because without those helping hands, it's really, really difficult to try to navigate corporate politics, especially a large one.
Yeah, and I can add a little bit more to that. I think Tae spoke really well on a lot of the how to really think about who you're talking to, but also I think one of the things that we really appreciate and we wish we saw more of is when a startup knows their competition, know who the other players are in the landscape. You know, the naivete a lot of startups come in is saying there's nobody like them, and that's not true. We do a lot of research on the back end. We spend a lot of time out about in the ecosystem, so we know who else exists out there. We want to make sure you know who else exists out there as well, and we want to know, how well do you know them? How do you stand out from the pack? How do you separate yourself? Because if you have that conviction and you're able to articulate your value proposition, your uniqueness, it's going to resonate much quicker with us, and we can then move that further down the chain, because we're not shopping it around to just one person or one BU. It's often happening with multiple BUs and multiple people. And so if you've crystallized your value proposition and your uniqueness compared to the competition, we can then take that back and we can relay that message much quicker and crisper. And that really clarifies a lot of the unknown about why company X versus why company Y. And that's a conversation that we often get stuck on because the startup themselves have not done their homework oftentimes and don't know who they're competing with in the market.
Let me just quickly jump in just to double down on that point, because it's very, very important. And I want to add another element there is why now? A lot of the folks on the R&D center that has a lot of experience, they can not only competition of today, but what happened in the past, why that specific technology did not work. Because I'm sure if you're working on an idea that no one really thought of, it's either brilliant or terrible. You should not be working on it. Most of the ideas are something in some tangent tried before and didn't work, and they'll always have those memories. So always say it can be a simple Moore's law. It can be a simple something's changing in the consumer front. Always say why why now, why this technology or why this business model works now that didn't work in the past. Very, very important part.
I'd agree with both those points that Aditi and Tae made. And I would also add, in addition to doing your research, both on the corporate you're talking with, on the mandates that they're trying to fulfill, as well as on your competitors and timing in the market, it's also really helpful if innovators come in with a theory on how we can work together and what the nature of the partnership would look like. That gets us to a much more productive conversation more quickly. As a global technology provider, we also have a number of different business groups, a number of different potential partnership avenues. And if we can narrow it down to the one that's most relevant for the particular solution, then that helps us assess and engage productively much more quickly.
That's super helpful. And I think maybe let's follow up on this line of conversation. There's a question that came in through the Q&A, basically asking about how are y'all working on the integration piece between the business unit or within the corporate structure when you're bringing in that new tech. And it's specifically, they're asking Brandon too, how do you think about sourcing for and the strategy around sourcing for the Climate Innovation Fund versus M12? So yeah, let's get into the nitty gritty of how this works.
Sure. As many funds do, we have both inbound and outbound sourcing motions. We really look to have a proactive view on what we consider sort of the innovation landscape. We do innovation mapping exercises for each category of our target technologies. So within the various principles I laid out, we've identified a set of 9 or 10 target technologies that are really go-gets for us and our team. And we look to have a thesis on those so that we have essentially the sort of prepared mind to react and respond and slot opportunities into an existing framework. So we do that market analysis, and then some of those companies come to us, and some we will just reach out and say, look, we understand you're working on, say, circularity in this sector. We'd really like to engage and understand the solution better. I think timing comes in again here, because a lot of times what you want to do, particularly with a strategic, is build the relationship before you're raising capital. And so that takes some amount of time to deeply understand the business, understand how a strategic could work with your company, and get to know the engineering groups, get to know the procurement groups in advance of the raise, at which point then you have the conviction, okay, there's a way for us to work together. This is really promising. So I think that for us, deal sourcing can be both inbound and outbound. I think both motions are really important so that we are agile in responding to opportunities as they arise, but also proactive. And trying to ideally engage a little bit ahead of the perfect time to invest is good, because then it builds a bit of trust and an understanding of the trajectory of the business.
Aditi, I know your team has worked through both that technology analysis pretty early on. Can you dive into this a little bit?
Yeah, so for us, we like to similar to Brandon's team, we have inbound and outbound. We do a lot of outbound. We will reach out to companies if we think they're interesting, or we find them through, we're out and about in the ecosystem quite a bit. And we also love VC referrals. Friendlies tend to, we like when they think of us and say, hey, have you looked at this deal and whatnot? And we will always try to follow up. But a lot of what we try to make sure we do is we meet these companies early, maybe the seed stage, pre-seed, seed. That's why we love working with SOSV, given that we see these companies early. We know they're not quite ready for us yet, but it helps us start having the dialogue internally to say, hey, is there an open need for this within any of the BUs? Is that something that might be of interest coming down the pike? Or what are some of the challenges that we're seeing in this, for the specific technology? So it starts allowing us to have that conversation early. And then as they kind of get ready with their seed, or maybe sometimes seed is not right for us either, but we can kind of see how they're shaping up in their seed round. And then really we can come in on their A round when they're, maybe they have a working prototype, or they're getting ready for something more substantial at that point. So we've spent a lot of time kind of following their arc, and we've spent a lot of time understanding this technology. And we've also had time to line up the internal BUs to say, hey, this is the right time to engage, because what ends up happening is our investment time frame, unfortunately, is a little bit longer. So it takes a while for us, and we want to make sure that we cut that time down. But we're also coming in at a meaningful point in the startup's timeline as well as ours. And so we try to engage much earlier when it's not a right time for both of us, but they know who we are, we know who they are, and we kind of can start having that dialogue and teeing up the right folks internally.
How does an early startup, how do they interpret like that process of going through a longer path of getting all of Honda behind them? It is lots of meetings. It might take a while. How do you advise these startups to sort of read the tea leaves and understand that this is actually going somewhere versus something else?
Yeah, we're trying to be as communicative and as transparent as we can. When we meet a company at, like, let's say the pre-seed or even early seed level, we tell them, like, let's say you're not a fit for us right now. That doesn't mean you're not a fit for us later. Our cycle, like, things are always changing for us. Priorities are always shifting. And what seems like a sure fit, or what seems like it doesn't work right now for us, 2-3 years later, we're very excited, we're extremely pushy, we're kind of chasing down the deal, and we're very eager to engage. And so we've seen, like, the teams have more of an understanding of the space, and they're more eager. They need some time to really educate themselves. And so what we advise a startup is, like, it's hard to do so, but have patience. And we're here to we act as a barrier, right? To say it's not the right time right now, but as you progress, these are some milestones we're looking at. These are some price points you need to hit. These are some demonstrations that we need to see for us to kind of open that conversation with the technical team or broader Honda. And we also say, if it's not a fit for us, we want you to know early on, so you can use your energy for other corporates or other customers, and so that you're not just chasing down a dead lead. So we've been really trying to be communicative and transparent in, is this going to be a good fit for us as a collaboration? Maybe, and if so, we'll tell you that. If not, is it a good fit for investment? If so, we'll tell you that. If not, we'll tell you that too. And one thing we also do tell them is, like, don't jump over us. I think if you jump over us, the path is just going to get longer, because it will eventually come back to us. We try to have more of like a stage gate process. And the challenge is it's going to create so many conversations, and Honda's a big place, that it'll just make things longer for you. So we try to make sure that we're having one conversation, we're giving you the most up-to-date information, and we're being as honest as we can.
That's super helpful. We do have a couple questions in here that I think fall under the general premise of how can startups know what are the technologies that y'all are strategically keeping an eye out for? So maybe we'll start with that one, and then we'll follow on with the next question.
of which are the technologies we're proactively tracking.
Or maybe more precisely, how can startups know that you all are interested in certain types of technologies? How can they know what your strategic objectives are?
Yeah, great question. I mean, we put it on the website, so and we are completely open to outreach. We have a inquiry form there that we look at every week and respond to. So we're very open to those type of inquiries, and have tried to be very communicative and put out lots of white papers. So an example would be in carbon removal, which is a category in which Microsoft is very much a large buyer. We've put out 3 white papers at this point on exactly what we're looking for in each category, whether it's soils or forests or engineered solutions. So we want to be very sort of clear and transparent in the market about the types of solutions we're looking for. Sustainable fuels and materials would fit a similar model there. I think also we may be unique among this group in that we also have some fund manager positions, about a dozen fund managers. Those are also on the website. And a lot of times we will see folks, communicate with those fund managers, get an understanding of, is this a fit either for that fund strategy or for a direct engagement? And that is, I would say, some of the sort of highest conversion, highest hit rate in terms of, is this an opportunity that's worth everyone spending time on it? So those fund managers are a great resource out there in the market as well.
Yeah, we have ours online as well. And then if you reach out with something, specific within a category, we revert back.
Okay.
We need to do a better job of creating content on what we like.
Okay.
To be honest, we've deliberately put out little content because we've realized once we put more content, only those startups get attracted. And also they say, because we're not in this certain category, maybe it's not a fit. So right now we're basically accepting all inbound requests through our websites. But yeah, to be honest, I think it's the job of the venture firm, whether it's a financial investor or the corporate investor, to put the word out on the market. And just like Brandon, we also, because we look at such wide range of industries and technologies, we do work closely with our fund managers, and that's probably our best filter and best referrals, as well as our existing portfolio CEOs. I think the best deals come through them.
I gotta imagine there is some element here of, this is all part of customer discovery. And for startups that are working, especially in climate tech, when we're trying to engage more closely with legacy industries, you kind of read into the corporate structure and start understanding what the business units are that are even there, and probably start going through that process, even if that strategy isn't clearly articulated on your website, for example. So there's still the work involved in trying to understand who that customer is, and that customer may just be one of the individual business units inside your companies. Why don't we, Marty had a question here about how you all are actually sourcing and actually whether there are events that you all especially like to attend, or other types of channels where you all are going hunting for deal flow. And so they mentioned whether it's INREL's IGF, the Industry Growth Forum, the ARPA-E summits, Verge, et cetera. Are you all out and about? Tae, it sounded like you're going to be at a big SynBio conference soon, for example. So,
no, absolutely. We love conferences. I like to go to conferences, not to actually sit in and listen, but to network with folks. It's just always good to be in a place where there's, like, for example, a climate week this week. It's so great to have friends all over the country, or even from overseas coming over a cocktail where you can just talk, you can just chat 5 minutes. So some of the events that I like, Enroll IGF definitely. ARPA E Summit is a very good one as well. On the bio side, I like SynBio Beta. From also when it comes to the more AI ones, and obviously the NVIDIA conferences. So we do like to go to conferences a lot. We try not to overdo it because sometimes there's too much of a repetitive. But we see these events as a great way to network, both with partners, other fund managers, as well as startups. And we like to do it more organically through face-to-face rather than just outbound, just after seeing it in CB Insights, news or pitch book. And it's always great to do that in conferences. So yeah, when it comes to selection of conferences, it will probably be the quality of attendees. Our perspective quality of the attendees of that conference rather than the actual content of the, although those two are probably not exhaustive or different. Yeah.
Brandon, Aditi, any?
I would echo the notion that conferences are one great avenue for connecting with groups like ours. We, Microsoft and Microsoft Sustainability have a presence at a lot of these events, the examples mentioned here and others. We do participate in conferences with our fund managers. We participate in conferences like Verge and some of the others mentioned here. And then this emergence of, the sort of scale up of New York Climate Week, London Climate Week, it creates, I would say, a more diverse set of in-person interactions. And I think I really welcome this sort of Cambrian explosion of climate activity everywhere. I think it's really good, especially given the scale of the challenge and the fact that you want not a single group rotating among a set of conferences on the same themes, but you really want treatment of different themes in different settings, and a recognition that this global challenge is here. So yeah, we have a presence at conferences. I would say that's one of several ways to reach out, and both of those sort of personal touch points and then sort of more intentional proposals are welcome. We're open-minded about that.
Same for us, where we do attend conferences, the big ones that have already been mentioned and others. We host our own events, either often co-hosted with other partners, or we'll attend if we're in town. Like I end up in Boston and New York a lot. So I'll try to, stop by and talk to folks for different things that are happening in the evenings, like SOSV might have something, or a VC is hosting a get together. So we try to be out and about in the ecosystem and meet entrepreneurs and investors organically, and really try to just be present. We try to be available, and we're always open to meeting new companies, new technology founders and creators, and just learning about what they're doing. And if we can impart some knowledge, then we're happy to do that too, or perspective.
Great. Okay, we have a very fast question. So everybody, here we go. What kind of traction do you like to see for a seed stage startup? And what about market size? We'll start with Brandon, and we'll go in circular order.
So we tend to look for proof of commercial traction in all the direct investments that we do, and we have seed fund managers who handle truly pre-commercial, no contracts, no paid pilots, and so on. I think that the earliest we've come in directly has been in the paid pilot stage of having commercial customers, but not at a full scale installation or unit in the field. And we want to see that commercial traction for two reasons. One, it demonstrates the viability of the end market. Is this a product that the end market wants to purchase? But second, it also informs the technology and the de-risking of that technology. And so in terms of direct investments, that's sort of the minimum that we would look for. More typically, we would want to see units in the field and a commercial pipeline. Our seed managers can go earlier than that, and we've got several of them. And so depending on the sector, they would be able to go even earlier in the product, formation stage, sometimes even when something is in stealth. And we really lean on them for that seed and even pre-seed stage opportunity.
Great. Tae?
It really depends on what type of technology they're using. If it's more a business model innovation, we definitely want to see some sort of actual commercial traction, even at a seed stage company. When it's a more deep tech company, just like Brandon said, proof of concept, but always we want at least some sort of LOI or customer or path to a customer traction. Much more than the initial market that they're targeting for some of these deep tech companies. Because sometimes the initial adopters of your technology might be a smaller market, and also the TRL, the unit economics of your current stage, plus, so you might not, so going after, for example, I'd much rather a startup go after a high margin, smaller market than a commodity market. That's just, the market size is humongous. So the market size question, obviously, if it's a business model innovation, you always want to look at TAM initially, but we always like platform technologies that can have multiple shots on goal, initially targeting those high margin, maybe smaller markets, but showing some sort of initial proof of customer interest, even at a seed stage company, because we always believe, technology is a tool to get to a good business, but every startup should have a viable, good business model, which always includes customers, and technology is always a tool to get to that success.
And
Okay.
Adity?
So for us at Honda, we strongly believe in seeing is believing. So something demonstratable, it can be an alpha, it can be the crudest of prototypes, but we want to be able to see it working for an engagement. And it would be great for the company to have customers, even if it's on a pilot engagement type, to show that there's activity and they're validating and they're de-risking with different customers in different areas. One of the things that we always worry about is when a startup is their beachhead is automotive. That's very difficult because it's such a long timeline, and so we want to make sure that they're diversifying their customer sets that they're doing piloting with, or even any form of testing.
That's super helpful. And maybe we'll take this other question here. I'm just going to read it directly. In climate tech, hardware-driven solutions take a longer time and require larger amounts of capital to build integrated, first-of-a-kind and pilot-scale facilities before moving into that commercial demonstration plant. How are you all addressing the challenge of funding these first-of-a-kind demonstrations when these startups are going to be pre-revenue, most likely?
For us, that's not if they have a pilot facility that they're building out, that's okay. It's a you have to walk before you run type of thing. And we recognize that's, as they're thinking about raising money, that's part of their raise, like how are they capitalizing to build out bigger and bigger facilities? Maybe it's piecewise, right? Like you have smaller, we're talking to a company that has a smaller energy utilization module that they can then keep adding on to increase over time. And you slowly can pay for it to get to the ultimate larger size, higher capacity, full functioning facility. So we want to just be able to see what plan you have. How do you think about scaling and getting to your end goal capacity? And how does it factor into the capitalization plan, whether you're at, your seed round or A round? Then does it make sense with the within your financials?
And for us, I think it's such a significant gap in the capital continuum that basically there's a portfolio of different solutions, right? And you have to really consider all of them. So if we are a customer of the unit, we will consider participating in project financing ourselves. That's obviously not a truly scalable solution. And so we also really look favorably at blended capital strategies that include either public capital, DOE or others, or private sector concessionary capital. And we're actually, in addition to the Climate Innovation Fund, which is only financial investments, we're additionally a donor to Breakthrough Energy's Catalyst program, which does that type of first of a kind financing for a set of 5 target technology areas. And so we definitely recognize it as a big and meaningful gap. That said, I think all eyes are on how we fill this gap, and it definitely requires more creative financing solutions, because mainstream capital markets usually aren't ready to take that on. And I don't see that changing given their underwriting requirements, but there are strategies where you would have some concessionary capital and then senior capital coming in together.
Yeah, just to build on that, so I mean, GS Group, when I laid out our assets, I'm sure there was some size, because we have been working in the fossil fuel-based economy quite a bit. But because we've been culprits, I also believe that we kind of hold the keys to the solutions as well. So in order to kind of address some of this, there are things that startups are really good at, and there are things that corporates are really good at. I'm telling our R&D centric folks, as brilliant as you guys are never gonna outcompete some of these startups when it comes to the actual innovation or the R&D side. What we're actually good at is providing that stable operations at scale, or help them scale up, both by providing advice, but if we can start opening up our facility to help them scale up, not only will we get a glimpse into some of the newer technologies, but also it could be a new business opportunity for GS as well. So with some of SOSV's kind of co-investment companies, we have started opening up our demo or pilot facilities for them to start coming in, using our facilities for scale-ups. Because I think that's where the marriage between the corporates, the venture the venture folks, also the early stage investors, but those project financing kind of PE infrastructure investors, they all have different roles. And in order to really catalyze this energy transition climate tech forward, I think it has to be a collaboration between those 4. But just like Brandon said, be creative with financing. There is a lot of non-dilutive financing out there, both from the public sector as well as the private sector. We always like to see, just going back to that last question, what kind of milestones do you want to see? When I say initial customer traction, I love seeing paid JDAs. I love seeing grants from prominent, very, very tech or science-driven organizations, as well as accelerators, because that's some sort of a market validation. There are some surprisingly capital light climate tech or biotech companies out there that have been creative, or that have utilized or maximized the utility of creative financing options.
That's a really great point. Also, I think maybe we'll hit one last question that does a kind of moves in a slightly different direction, but it actually gets to this question from Carl around the value of IP and how you all look at that as, as part of this long journey that you might be taking with your companies, and what is that value that you place there?
I would say it's very high. We're always looking. We want to know, do you have have you licensed the IP out? If it's technology coming out of university, what areas are you protected against or patenting? And really, it's about how are you building a moat for yourself, given, as we talked about in the beginning, right? Who are your competitors and how do you defend against them? Where is your uniqueness? And really the IP portfolio speaks to that. And so I think we spend a lot of time talking to the startup about that, understanding the IPs that you've filed or been warranted. And it's a really important part of what makes the startup truly unique, and how they differentiate from the pack.
Sure. Okay, I know for some of your CapEx light or asset light companies, the IP kind of plays a big part there. Can you elaborate on that a bit?
Absolutely. So, but yeah, this might be a weird response, but IP is really important. But the more important thing is the trade secret, and that's what I mean by I want to see the commercial attractions of these companies, because IP is basically you're making what you're working on pretty public. So if what you're working on is a real secret sauce, usually you probably won't patent it. You'll keep it in the trade secrets. Companies like corporate VCs, unfortunately, it'll be very difficult for us to get into that trade secret, because even with an NDA, they don't want to share the actual like secret sauce that they're doing. Just because we can, if we were bad actors, corporates could take that and do it at a bigger and faster scale. But I think obviously IP is very, very important. IP plus trade secret, but how you utilize that IP and trade secret is how do you execute on that is much more important, because if you only focus on IPs, the academia has much better IPs than the startups. It's just how do you monetize on that IP with protecting yourselves? It can be first mover advantage. So I think IP alone is important, but not the most important thing. It's the whole system of how you create a business and using IP as a tool. And I think that's what some of our capital light companies have been really, really good at. They're showing the IP value of the IP, but the reason why you need to work with us is because what you're not seeing in the IP or the patents is our secret sauce that you guys probably won't be able to replicate.
And Brandon, if you want to chime in.
No, I think that was well said, and agree with that characterization.
Okay. Well, we've got about a minute left here, and I think that is probably a really good spot for us to wrap this up. I think it's super helpful to hear how these three very different corporates are engaging with startups and being very proactive to build partnerships, help facilitate, in taking the technology, doing demonstrations together, and really bringing the full force of your entire corporate structure to bear on the successful launching of these early stage companies who we hope can help bring change to our very carbon heavy economy. So thank you again to Adity, Tae, and Brandon for taking some time out today to share your thoughts and your strategies and be a part of this.
Thanks so much.
Thanks,
Thank you so
everyone.
much.
Thanks, Pae, for facilitating. Have a good day.
Yeah. Thank you.
Thanks.